Happy Monday and welcome back to Real Estate Mindset. We have another live video for you guys. Everything is going to be chaptered. I'm going to rush right into market closing to show you guys what happened, and then we'll discuss why. And then I'm going to come back to the comment section, and then I'm going to start saying hello to each and every one of you. So don't forget, if you're in the comment section, start saying hello. But take a look at how the market ended, you guys. Absolutely insane today. Dow Jones ending 2.48% down, or 971 points declined. A lot of turmoil in the markets like we've been warning you guys about. If you guys have a pension or 401k, you're probably noticing the volatility in those accounts. S&P 500 also down 2.36% or 124 points. This was down even more than that, so it did rebound slightly towards the end of the day. You guys can kind of see that in the chart. When we keep going forward, the NASDAQ also down 2.55% or 415 points. You guys can kind of see also a little kind of a late, not a rebound, but it covered some ground there. Now take a look at this, guys. The VIX absolutely exploding again today, still under 40. So we saw this shoot up to almost $50, $60, then go back down. 40 is kind of the magic number, or something I'm looking for. Up 14% today, closing at 3382. And again, that's a volatility index. Okay, moving forward, take a look at this. You know how much we've been talking about, and let me know that the reception is okay, guys. But you guys know how much we've been talking about gold. We hit a new record high today. We're up at $3,436. My God, gold is on a tear. I think this is, if I'm not mistaken, Mitch, has been outperforming the stock market, if I'm not mistaken, this year. Moving on, you guys, crude oil ending, not quite ending, but down about 2% at $63 a barrel. Remember when this was at 50? Was it 57 or 56? Absolutely crazy market. Here's the Dixie, you guys. If I'm not mistaken, and this is still open, we hit a record low, or at least a 52-month low on the Dixie earlier today at 97.92. So the dollar is taking an absolute beating because of how they're spending, right? Obviously, they're not spending very wisely, and so we're starting to see that in the Dixie and the dollar meltdown. So we're going to get to play by play. We're going to talk about what happened exactly, but I just wanted to say good morning. Good morning. I always do that. There's my buddy Johnny. I wanted to say hi to everyone. There's my buddy Johnny, Carlos, my buddy Tom. Tom, where are you at in the new Discord? I'm going to show you guys the Discord. Monica, always nice to see you. Absolute pleasure. P Nice, George. So nice to see everyone. Obviously, there's Mary right there. Appreciate you, Ray, as well. Red. There's Merlin. There's George. Good evening, everyone. So, Mitch, don't give him any spoiler alerts. I'm going to go into the next portion here in a minute. But how are you today, sir?
It was a very interesting market. So it's a little bit misleading with what Travis had just gone through. Like the NASDAQ was down 650. Now, the good news is that it wasn't an out-and-out panic, which is why you saw the VIX only at 33. It was very orderly, but it kept going down and down and down, and gold kept going up and up and up. So at least it wasn't a panic. Now, some people would look at it and say it's horrible, but it wasn't a panic. They weren't looking for the doors.
Yeah, I mean, and we're going to show you guys, I'm going to get to the play-by-play, and I'm going to show you guys at least what Market Watch is saying happened to the stock market. But before I do that, I wanted to let you guys know Mitch and I made a banger juggernaut of a video this morning. It's about an hour long. We're going to release that tomorrow morning. It's going to go into the fraud and debt bubble. So absolute banger. I'm telling you guys that because normally when we do a long video, it absolutely tanks. So if you see us release that video tomorrow morning, make sure to click on the video and watch it. It's also going to be chaptered. But I want to explain a few things to you guys. And we're going to talk now about the brief explanation on the fraud and debt bubble, property taxes, and then we're going to go into a full market update. So I'm going to do our second timestamp actually right now so you guys can come back and take a look at some of this information. Now, as far as the fraud and debt bubble, so we stopped saying the everything bubble, right? We're now saying the fraud and debt bubble because that's exactly what it is. I want to show you guys a couple pieces of information, and then obviously again watch the video tomorrow. That's going to go into massive detail. But the first thing I want to explain when we're talking about the fraud and debt bubble is the derivatives market. Okay, so this is from Investopedia. I just want you guys to remember the difference between the notional value and actual netted value. So the netted value is 12.4 trillion. So they've taken 12.4 trillion and levered it up in the derivatives market to 600 trillion. That is a fraud and debt bubble right there. So from 12.4 to 600, are you freaking kidding me? Who do they think they are? The Federal Reserve? Also, fraud and debt bubble. The other thing I want to show you, next set of data set, is on page 3 of the First Amendment to the criminal complaint. Remember, you guys, we have this stuff for free. So you can literally get this document right now. But this is page 3. And I just want to look at the first line. Okay, so what was that? Aledo ISD. So this is a school district bond debt. And just this one school district, they have outstanding bond debt of 664 million. When you do and take the total amount of households and you put that into the bond debt outstanding, that equals $372,000 in bond debt per household. So those are probably the best 2 pieces of information as far as the fraud and debt bubble. Also, want to remind you guys of the admission of guilt, because a lot of people right now are getting their property taxes and their property tax assessment notices are absolutely skyrocketing. So I want to remind you, this is from the Central Appraisal District in Austin. They're supposed to create value based on mathematical formulas from USPAP. We've been warning you, they're not doing that. They're taking the budget from the school district and they're backing into our home values using that budget. And this is Austin right now, Central Appraisal District. Changes in market values do not translate directly into changes in property tax bills. Instead, values determine a property owner's portion of the total tax levy. The total tax levy is determined, here it is, by the budgets set by the local taxing entities like the school districts. Okay, so again, determined by budgets. They literally, it's an admission of guilt. And guys, let me know if the reception's okay. I think my reception's a little bit crappy right now. I'm not 100% sure. Now, this last thing here, guys, on the bottom paragraph, last year, the typical Austin homeowner saw more than a 13% increase in their property tax bill. Okay, now that's for 2024. And in order to determine 2024's value, remember, they had to use 2023 comparables. So they're saying in Austin, using 2023 comparables, that home values went up 13%. Everyone with a pulse knows that Austin did not go up 13% in 2023. I have the data right here. In 2023, Austin was down anywhere from 5 to 20%. You guys can see the peak was in May of 2022. Austin was sitting at roughly 660,000 median sales price. That's all the way down to about 512. My point in telling you guys this is the Central Appraisal Districts are bullying people and making things extremely confusing and ripping people off. And we've got to put a stop to that by protesting the home value. So if you're in Texas or really any other state, you guys have been getting notices just like this, okay? Something of this nature. Every state's a little bit different and Central Appraisal District slightly different, but you're going to get something like this that says this is not a tax bill. This is a notice of assessment. When you guys get this, it's important to start this protest process as soon as you get something like this. And even if you don't go to the ARB hearing, more than likely the Central Appraisal District will try to settle with you before your hearing because they want to get rid of you. So one person I talked to got, and it's on the post in the comment section on the YouTube channel, got a $113,000 break. $113,000 off his property just by starting the protest process. So a lot of you guys in Texas have been getting that, and it's been unfortunate. Now, if you get this and you want to learn how to fight and protest properly, you guys can go to realestatemindset.org and also have a seminar this Saturday, but you guys can go to realestatemindset.org. Just scroll to the bottom. This is the course you need to take. Fight Property Tax course. This is a free course. All of the forms are free. Everything is completely free. If you want to help us eliminate and end property taxes permanently, you go to this course right here. Now, if you guys want additional communication, you guys want to join a new Discord server. This is our brand new Discord server. It's a subscription-based server. We have finally made this. Mitch and I made this so that we can better respond to people. So if you guys want to continue to talk to us, this is $10 a month. Sign up right now. 2 areas of topics in our new Discord. The link is in the description. First topic is anything that has to do with property taxes. Second thing is learning the math to find the deal, especially if you're a new homeowner. This is a community we're building for people, helping people. We also have the free Discord right here. You guys already know about the free Discord. This is a subscription-based Discord. Literally, if you're watching this, hit the description in this video and sign up. It's $10 a month. The sooner you sign up, the more attention you guys are going to get. We got about 6 people standing by, and we've only had 1 person sign up because I just released it right now, literally on this video. So the sooner you join, the more attention. Also, real quick, this Saturday, April 26th, if you guys want to learn how to protest property tax home value, take my seminar. It's this Saturday, especially if you're a realtor, because I'm going to teach you how to be a pro. So if you're a realtor, you want to take this so you can teach your clients how to properly protest. And another reason why you'd want to take this if you want to teach other people how to protest as well. So I will be holding your hand through this entire process. I'm only doing 25 spots this time, so make sure you guys take that. Now, as far as the market update, sorry for that long-windedness. And again, remember, in the description of this video, sign up right now. Now, as far as the market update, I'm going to show you guys the play-by-play. Then we're going to get some insights from Mitch Vexler on what happened in the market. But this is according to Market Watch. I always find this hilarious. Okay, so this is a play-by-play for Market Watch on what happening, orderly disaster. Okay, so stock market news, April 21st, 2025. Dow ends down 970 points. People are starting to get used to that, desensitized. S&P 500 and NASDAQ finish sharply lower as Trump slams Powell. So nothing to do with fundamentals, right? They're blaming this on Trump slamming Powell. That's crazy. Dollar tumbles while gold hits record. So we got the dollar decline. I showed you guys that. And gold hitting a new high. Let's go down. Okay, so 53 minutes ago, this is what they said. U.S. stocks finished sharply lower after Trump slams Powell again. Absolutely ridiculous. Number 2, United Healthcare stock has shaved nearly 1,000 points off Dow across its worst 2-day slide since 1998. Very interesting. Big tech ETF posts big drop as Tesla sees steep slide. More bad news for Tesla. Not good. 30-year treasury, and I'm going to show you guys mortgage rates, absolutely crazy mortgage rates today. 30-year treasury yield leaps to 3-month high. That's crazy amid sell everything trading. Massive jump in the long end of the yield right there. Massive dump. Stocks oversold and ready for a bounce, but catalyst remains elusive. Again, this is what they're saying, play by play. Okay, this will likely be just the second day since September of 2022 in which every S&P 500 sector closes down 2% or more. Very interesting. 2 hours ago, here are the assets that may benefit the most from the dollar weakness. And you guys can kind of see right here. I don't believe in any of this absolute ridiculous nonsense. I'm going to keep going here. And real quick, the weakness in the 3 major Dow Jones indexes is unanimous. So everything is not doing well. Retail buys the dip, but institutions are on the sidelines. And here's another one. I mean, literally, before we started this is the headlines. A firing of Powell by Trump would lead to a dramatic rush to the exit on U.S. assets, according to a strategist. Very interesting stuff. Rumors of dollar's demise as global reserve currency greatly exaggerated, economist says. That's very interesting headline right there. So that's your play-by-play, guys. I'm going to go back to you, Mitch, now, and let's talk about, and you guys comment in the comment section. I'm going to get to your questions and comments here, but Mitch, can you give us a rundown? I know you were following the market pretty much all day when we got done with the video, and I'm editing, and Mitch has texted me, oh my God, the market's crashing. And I'm like, leave me alone, I'm trying to edit. It was a super long video, you guys. I mean, absolutely, I'm so proud of this video. Probably no one's going to watch it. Should not have said that out loud. What happened today, Mitch?
It was, as I said, a very slow grind down, but not a panic, and that showed up in the VIX. So with regard to the 30-year treasury, I did see somebody's comment in there, why are interest rates going up? Because the market has nothing to do with Powell, and interest rates go up when fear and or risk becomes exaggerated in the marketplace. And as things drop, even though today was slow, we've had some pretty big down days. And that's what creates the fear, and that's what creates the interest rates to go up because risk is coming into the market. That's also what causes gold to do what it is doing, which is simply unheard of. It's never happened in the history of the world where gold has jumped. You can even go back to 1970. They didn't have these type of percent runs that we have had in gold. And gold's rate of return just this year alone has far surpassed that of the stock market. So precious metals, silver did dip, but it's way up. It's already 50% of its way back from its major dip, and it's just going to continue. It's going to continue to climb. So these things tie to the document that I did with the, you're about to see it tomorrow morning. And there's really the thesis and fact. That was part one. Part two is going to get released tomorrow. And what we're about to go through later in this video is understanding how the debt clock is all tied. So these things are all headed your way momentarily. No sound.
Sorry about that. So, and that was a good transition too. Dang it, I totally messed that up. But I was going to say, maybe this has more to do with the debt and fraud bubble and the derivatives market absolutely imploding and unwinding, and then all this 100%. Other levered up. Yeah. So we're going to listen to a video though, Mitch, and this video is interesting. It's going to be on how the market is saying that it doesn't. This is literally the headline of this video. I'll throw it up real quick so you guys can see. It's absolutely ridiculous. Look at this headline. Let me remove this real quick. Market has signaled it doesn't like the idea of Trump firing Fed Chair Powell. Oh, really? Is that what the market's thinking right now? That's very interesting. So that's this video. Okay, we got Mitch's perspective. Now let's listen to this bozo's perspective. And I'm not going to listen to the whole thing. It's about 8 minutes, but it's very interesting because these guys are out of their minds. Let's listen to what they have to say.
Vice Chairman, and maybe you can speak to the question that we were just talking about earlier with Tom here. Do you imagine that the president could fire this head of the Fed? Is that even conceivable to you?
So I think even at this moment, it's probably not likely, but it is clearly in the conceivable set. It's something that we have to take seriously, as a risk, and I think a serious risk to markets.
And if he does that, what do you think is the risk to markets? But then secondarily, what do you think of this sort of shadow idea? It's something that Scott Besson had raised before President Trump was elected. This idea that you could nominate effectively somebody who was, in this case, I imagine you'd have to find somebody who's famously dovish and announce their nomination, months ahead of time, in which case that somehow the market sees through whatever this Fed chair is doing with the expectation that the next Fed chair is going to be significantly different.
So let me take those in order, if I may. So first of all, I think we're already seeing, like right here and now, in the equity futures, in the dollar, in the bond yields, we're seeing a clear signal from the market that it doesn't like even the idea that the president might try to remove the Fed chair. There's been some loss of confidence in U.S. economic policy making in recent weeks. We've seen that in this very odd combination of upward pressure at times on longer term bond yields combined with a weaker dollar. That suggests global investors pulling capital out of the U.S. But what you've seen is ongoing confidence in the Fed. You've seen ongoing confidence in the Fed, and that is crucial. You've seen those inflation expectations well behaved, well anchored. And that's what will eventually allow the Fed to be able to cut rates when we get to the point that unemployment has increased materially. But if you start to raise questions about Federal Reserve independence, you are raising the bar for the Federal Reserve to cut. If you actually did try to remove the Federal Reserve chairman, I think you would see a severe reaction in markets with yields higher, dollars lower, and equity selling off. I can't believe that that's what the administration is trying to achieve. Now, with respect to the question of, what are we doing in terms of shadow Fed chair? I think it's not a great idea to have someone out there trying to second guess the Federal Reserve chairman, but it would be less dangerous if that person did not have a seat on the FOMC, and there are no vacancies right now.
Right. Okay, so let me ask you then a different question, which is, and this is kind of an interesting meta maybe idea here. We all think that Jay Powell is quote unquote independent today, But of course, whoever the next person is, you would hope is going to be independent too. But it's possible that you would see that next person as a puppet of the administration, maybe not independent. I don't know. Would the market have the same kind of reaction?
So I think it's really important that whoever takes over from Jay Powell should take over in good circumstances, in circumstances where that person looks that as he continues to have the independence that all Fed chairs have had in the modern era. That's going to set the next Fed chair, presumably someone who Trump wants to occupy that position. It's going to set that person up for success. But if it looks like that person is coming in without weakness, without independence, at the beck and call of the president, then you would set up the next Fed chair for failure. And I hope that on sober reflection, the administration will understand that, look, by all means, it's the president's right to nominate the next Federal Reserve chair in regular order. They should think about how trying to set that person up for success. So it also rebounds to the success of the administration as well.
Christian, I worry about trying to, anticipate the future for the Fed, because they notoriously have not really been good at doing it. Maybe it's just the nature of the beast, that it's almost impossible. You're always looking at the rearview mirror in backwards data. If he were to be wrong again, and if inflation isn't really the problem right now because of the tariffs, and we really are going into a slowdown for a lot of reasons, trade wars, everything else, and if we're late, and we should be cutting now, and everybody again says, uh-oh, looks like Trump was right and Jay Powell didn't lower rate, it would be bad to go out on a mistake. So that's what I mean. I don't know if he'd be set up for success. It'd be almost like you should have gotten rid of him earlier. And all these guys are just, they can only be right for so long. I think a lot of times they should get out when the getting's good.
So look, I think it's always the case that the Federal Reserve is only making the best judgments that they can under extreme uncertainty, and it's going to make some mistakes. I think those mistakes are, of course, still more likely when you're being hit by very difficult shocks. And a big trade war is a big man-made shock. It pushes inflation up. It pushes growth down. So is it possible the Fed could make a mistake in this environment? Yes, it absolutely is. And the question that you have to ask yourself, the question I think markets have a lot of conviction on, is would you rather have an independent group of people, an independent group of experts trying to make those calls as best they can? Or do you think those decisions would be better made under political pressure? That's the issue.
We've batted around a whole bunch of names over the years of potential Fed chairs. And one of the questions we were just discussing earlier is there somebody out there right now that you think is, quote unquote, famously dovish, meaning to the extent that you would want to nominate somebody who the market would see this way, who is that person?
So I'm not actually sure you'd want to nominate someone who is famously dovish. You would actually want to nominate somebody who has very strong hawkish credentials. And so the market would trust them, including to the point where they decided that it was appropriate to get cutting on interest rates. If you nominate someone who has a very dovish reputation, then the bond market would riot. So that's why I think there's interest, for instance, in looking at former Fed Governor Walsh, who does have a reputation as being hawkish. Again, I think the manner of the appointment would be crucial.
Okay, so wow, what a brilliant discussion. So the market would crash if Jerome Powell got fired, maybe because the market would understand that they can't print money anymore and there's no Fed put. Yeah, maybe it would crash because the market's expecting it to be bailed out by the Federal Reserve, because that's what they've been doing for the last, I don't even know, Mitch, 20 years maybe. So they got a pretty good record at rescuing the banks. I'm going to set up our next segment, which is the mortgage update. But do you want to respond to that brilliant video we just watched, Mitch?
Okay. I wrote down a handful of thoughts. The Federal Reserve is a complete failure. That's the first thing. I produced a document called Thesis and Fact that lays that case out. And the video that's coming out tomorrow morning is more than enough information that if President Trump had his hands on it and the time to look at it, would justify chaining the door shut of the Federal Reserve. The next comment I had was the existence of the Federal Reserve is moral hazard by definition. They created it, they invented it, and they backstop the banks on the back of mom and pop. And then the other comment that the guy made is just out and out insanity. You want to know what the market really won't like? They won't like a greater depression. The Federal Reserve needs to be shut down. Interest rates have got to be left up to the market to determine what they are based on the risk profile. And oh, by the way, what about the 600 trillion in off-balance sheet derivatives that the Federal Reserve has allowed to exist? Every single one of these clowns that they put in charge of the Federal Reserve, no offense personally, but every single one of these clowns is incapable of negotiating a lollipop away from a child. If they were going to negotiate something and have a meaning and stand up for a legacy, they would literally say and be jumping up and down on the table in front of Congress, this is what you must do, and these debts have got to go. But not a single one of them has had the guts or the brain power necessary to do it. And what you now have, and we're going to get into that shortly, is a compound cumulative effect of the compounding of the interest on the compound debt. All 100% of that statement falls at the feet of the Federal Reserve, and it is irrefutable.
We've got one more question for you, and then we're going to go to the mortgage update. Mitch, would you say that the Fed is a bunch of hosers? Would you agree with that?
Must be
Would you
a fellow Canadian, eh?
Really? Is that where hosers is from? I
Yeah.
didn't even realize that. Okay, that's funny. All right, let's get on to let me get the timestamp real quick, and we're going to do the mortgage update. And we're going to go over some pretty cool stuff as far as mortgage is. Let me throw up our mortgage update section. Go into our second camera. My God, guys, this has been absolutely insane. What you're looking at here is the 10-year treasury. I don't know who was watching this today, but personally, I've never seen anything like it. Let me see if I can show you guys the 1 day. I can't because it just updated, so it's blocking it out. But essentially, look at what happened to the 10-year. You guys see that V right there? It had a V. So I've seen this happen before, and right around COVID, when we had radical changes in pricing like this, I remember banks would suspend the ability to lock an interest rate because the volatility is too overwhelming for them to properly price out interest rates. I mean, look at this. It started the morning out at 4.4 and dropped all the way down. Look at how it's crazy. It dropped down to 4.34. Okay. I don't know why it dropped. And then it shot up and skyrocketed back to 4.1 or 4.41%.
I do.
I don't what happened?
Right where you were just pointing. You see that bottom?
Yeah.
If you draw a line to the left, you will see a top. So what that pullback is it's testing that. No, keep going.
Right here.
One more.
Stop.
Right there. That's what it's testing. And that's
Okay.
what the market does. It goes up and it comes back. So what it did, that became resistance. So resistance becomes support, and that's why it touched it, and then it bounced right off.
Wow. I mean, how much? I mean, it takes a lot of money to do that, wouldn't you say, Mitch?
Well, the people that are playing in that market are international banks and U.S. banks and sovereign wealth funds and private equity funds. And typically they have a lot of money.
Well, and they're affecting us as U.S. consumers because a lot of things are attached to that 10-year right there, including what you see right here. Oh, wow, this is crazy. Residential mortgage rates. So what's interesting is this updated and it just re-updated. I don't think I've seen this update twice before, but right when we started it, it showed mortgage rates were up 7 basis points. It's now showing 11. It's probably overcorrecting because obviously the 10-year didn't go up 11 basis points. But nevertheless, you guys, the conventional mortgage rates right now are at 6.98%, 30 years at 6.45%. A lot of gap between the 15 and the FHA right now. FHA has been under 15, 15-year fixed conventional for a while now. Remember, you guys, shop your mortgages. You have a grace period. But the most important thing when it comes to getting a mortgage, the most important thing by far is understanding this death sentence, which is called an amortization schedule. And what I did is I put arguably the average loan amount of $324,000 over 30 years at a 6.98% interest rate. Now, I'm going to show you guys what making 2 extra payments per year will save you. Now, remember, if you guys have heard of bi-weekly payments is only adding 1 extra payment per year on your mortgage. So we're going to say, okay, well, what happens when you add 2 extra payments per year to your mortgage, how much would you save? The first thing I want to point out is your monthly payment would be about $21.51, meaning if I'm going to show you guys 2 biweekly payments or 2 extra payments a year, I have to show $4,300. So it's basically, I'm doubling that number right there. Now, if you don't do anything, you don't listen to me, you're going to end up paying $774,000 back to pay off $324,000. In other words, if you don't listen, if you don't pay this off, if you just keep refinancing, you're wasting your money, and it's better off that you rent and take the difference in the rent versus mortgage and invest that money. Because again, this is a death trap. So don't refinance, okay? Because look at guys, case in point, first year you pay $22,000 in interest. Last year, you pay $950. You guys get it? Now take a look at this. When we do the optional payment, when you see where it says make extra payment, what I'm going to do is extra yearly payment right here. You guys could do the same thing. I want you guys to get familiar with this. I'm going to do 2 extra payments per year. So it's like biweekly, but hyper biweekly. So that's $4,302. Let's calculate if I did that every year, what's going to happen to this loan? Anyone have any guesses in the comment section? Take a look, guys. 2 extra payments per year. It turns your 30-year loan into a 19-year loan. Again, if you just 2 extra payments, guys, $4,300, you turn it from a 30-year into a 19-year, 9 months. But look at this. Look at how much money you save. Oh my gosh. Please listen to us. You don't have to learn the hard way, but you guys save $178,000 in just interest. Just interest, please. Make some extra payments to this mortgage. Get out from underneath that. That would be a great investment. Now, if you're wondering, are mortgage rates going to go down anytime soon? Probably not. But what you're looking at here is the federal funds rate, which does not directly impact residential mortgage rates. The market is saying in May, the next time the Federal Reserve meets, they will not be cutting interest rates. They will have interest rates remain unchanged. 92% of the market is thinking that. First rate cut the market's thinking is now going to be in June. So about 75% chance, about actually 75 plus 2.8. So 77.8, 78%, we'll round up 78% chance of a rate cut, 22% chance that no rate cut. And again, even if they do cut rates, guys, that doesn't mean that as consumers, you and I are going to benefit. Remember, this whole game is not about us. They just need us to continue to spend and to get into debt so the system keeps running. The moment that you and I stop spending money, it falls apart immediately. Now take a look, guys. This is probably why they're not anticipating another rate cut. Inflation's still crazy, and it's always been crazy. It literally never got any better. Jerome Powell wasted our time because they did quantitative easing and forms of bank bailouts during when there's supposed to be quantitative tightening. But here's the 5-year break-even inflation rate. And although we've been making progress as of about end of February, you see it's been trending down. We're still well above the Federal Reserve's goal of a 2% inflation. But probably if you're watching this, our goal is deflation. So what we want to see is a negative sign there, not it going up less. We want it to go down so that we can afford it because our incomes most likely, when adjusted for inflation, did not go up. Just everything else went up, especially fraud, greed, corruption. Now, another reason why the inflation has been out of control is the government deficit. We're sitting at $1.3 trillion in government deficit so far for the fiscal year of 2025. And remember, the fiscal year goes to October. Another thing, quantitative easing. Overnight reverse repo market. The money's not going to come out of this account. Mitch has pointed this out a lot. When this goes down, things start to crumble. And look, it went back up. So this isn't updated yet. It's updated on the upper left right here, but the graph itself is not updated. But this is going to have a pretty sharp increase above this gray line. So when this is finally updated, it's going to be above that gray line. Right now, there's $114 billion in the reverse repo market. Okay, so I'll go back to you over here, Mitch. That's going to conclude that portion of the video, which is the mortgage update. I'm going to go into the jobless claims. But Mitch, did you want to talk about why, if people want to invest, some people got a lot of money, how investing in their mortgage could be the smartest, safest investment to make right now? Can you explain that?
The idea of doing biweekly payments or any payments requires the borrower to remember, get an amendment to your loan document that allows principal reduction at any time without notice and without cost. Then the answer to Travis's question would be, because not only do you save between 17 and 19 years off of your mortgage, but when you run the math, that turns into about 4% per year, which is better than having money sitting in the bank. And that's why buying down that mortgage makes so much sense, not to mention the fact that you end up owning the house, and eventually, with a little bit of luck, the real estate taxes will go away. And that then becomes your security blanket for your retirement.
What do you think about this comment right here? I like it. This is from Charles Watkins. We the people, excuse me, I'm sorry, guys. Should have drank some tea. We the people, it was a video that we did today before this. It was an hour and a half long. We the people need a new government, the crooks on both sides. I love this man so far. Yes, both sides. It's like professional wrestling. You know, when The Undertaker used to fight Hulk Hogan? Dude, as soon as the show's over, they're in the locker room giving each other high fives. So, yeah, we put on a great show for the people. But it was all fake the whole time. It's the same thing with politics. But both sides have stolen all the taxpayers' money. And here we are, no place to live, no food, and no money. And they are all rich. We have to do something. What do you think about this man's comment?
Basically, it's true. The problem is, if they decide to pump this up one more time, you will end up in a greater depression. And even though they think they're rich, and it is clear a lot of money has been stolen, that money will disintegrate and that value will disintegrate, because the debt load is so large. In total, you're approaching $2 quadrillion. There's no math on this planet to justify it, and it's not just here in the United States. Unfortunately, the existence of the Federal Reserve allowed its pollution to go around the globe, and we are a bad kid on a really bad block in terms of currencies, and they're all in the same problem. China's got a huge debt load that they can't handle. The Chinese economy is upside down, and it's getting worse by the hour. There's problems everywhere. So this takes some serious people to think it through. But as far as this comment is concerned, that's the reality. And our documents back it up.
I wanted to say real quick, Raymond, I'm proud of you, brother. That's all I wanted to say. He's saying depressions don't matter. Raymond, he was there from the beginning. I've watched this young man grow. I really love him. Hope you're doing well, Raymond. Now, Mitch, just one thing before we move on to the video here on jobless claims. Can you explain? And we got a super chat, and we'll get to this. But can you explain how money printing could actually be a situation to where it would cause our economy to crash even faster, or at least mom and pop's balance sheet? Can you explain how it would probably do the opposite of what most people would expect? Because most people would expect, if you're going to do a bailout, it's going to make the bubble bigger. Why would doing a bailout potentially not make the bubble bigger, but collapse it faster? Can you explain the probabilities there?
They've printed in the last 5 years roughly 15 trillion, and that was on top of the 12 trillion that Obama pushed into the economy. There is no math. We've run it. As a matter of fact, we're going to get into that shortly. That's part of my presentation towards the end of this. There is no math on this planet that can pay that debt off. The mirror image of exactly that, not the printing, but the stealing. Stealing occurs by virtue of inflation. Inflation is a hidden tax. That money from the federal side goes to cover off, in theory, the interest on the debt that they have created. The problem is the debt plus the interest that they've created compounds cumulatively. Then they end up in a deficit like they did last year in 2024, 1.8 trillion, which would have been money to go and pay down that debt and interest, but for the simple fact that they keep adding on and not paying it off. Well, that's the exact mirror image of what is happening with the real estate taxes. So on the real estate tax side at your local central appraisal district, they just simply lie and say, well, we've got a budget and we have to hit the budget. So we're going to curve fit the values of the houses and the properties in this area to meet our budget. That's a violation of every single appraisal law ever written on the planet. And they've been caught. We've documented it. It's verified. We have sent it over to the DOJ, care of Pam Bondi. It's all there. It's in the First Amendment to the criminal complaint. That's on Travis's site. It's also on my site. They cannot get away from the facts. bottom line is that if they print, you will end up in the Weimar Republic, because what is the value of that paper? You cannot trust the government to say, well, that IOU, that value of that paper is the IOU, is worth anything. So the fear in the market then becomes just like what happened in the Weimar Republic in Germany. Well, it took a wheelbarrow of Deutschmarks to go and buy a loaf of bread. That has happened in history, and it has happened in multiple countries. It's happened in Zimbabwe. We're at the end game. That's why I keep saying this takes serious people. We know what the solutions are. And the reality is, you want to take the first step, chain the door shut of the Federal Reserve. And we even have a step-by-step process on what to do.
Yeah, I mean, we have so much for you guys to take advantage of the free material, please. I want to get to that video, but we have a super chat. Appreciate you, JG. Thank you for the support, buddy. He's saying that Bernie was right. This is the age of the billionaire has arrived. I can't help but feel like he's spot on because of the massive wealth transfer that's happening through the hidden tax, which is inflation. I mean, how is this not the age of the billionaire? And how has that not arrived with this inflation? What do you think about that comment, Mitch?
Well, the comment is dead on point, except for the wrong reason. So the age of the billionaire started back, and that's part of the video presentation that's coming out tomorrow morning. It goes back to the Rothschilds. And in Italy, it goes back to the Medici. Anybody who can control the debt and control the interest controls the market. And the existence of the Federal Reserve since 1913 was built on that premise. It only existed for the sole, single purpose of backstopping the banks and keeping them in business on the backs of mom and pop. These trillions of dollars that we're talking about here, just on the local U.S. national debt, plus the unfunded liabilities, we'll get into that, totaling roughly 160 trillion, 157 trillion between friends. It's a spit in the ocean when you understand that the Federal Reserve has allowed the exchange of derivatives, and the derivatives aren't even marked to market, totaling another 600 trillion. So, like I said, there's no math on this planet to fix this. There's going to have to be work downs and workouts, and the people that are the conspirators who have created this problem and the co-conspirators, they need to be shown the door. There's 23,000 people in the Federal Reserve, and what you're about to see shortly, you're going to ask yourself, what in the world do they even have a job for?
Okay, I got another super chat right here. Thank you, Angel. Appreciate you, Martinez. This one hurts. Me and Mitch talk about this all the time when we go back and forth with each other. Like, hey, no, they're going to print, and this is what I'm worried about. It's this comment right here. Weimar conditions are even eventually going to lead to Weimar solutions, which, if I'm not mistaken, was a war.
Yeah, we don't want to go there.
No, but mom and pop, thank God, is starting to wake up. Hopefully these videos and the material and the digital downloads and all of the theses that you've been making, the criminal complaint, the presentation to Musk and Trump, hopefully people are taking that seriously and understanding that we can create a solution now without that solution on the bottom of your screen. Thank you for the support, brother. I really appreciate that. Let's go to our video now. Let me set this up. This is on the jobless claims that came out. So it's a quick update on the labor market. It's cooked data, but regardless, let's hear what they have to say. If you guys can, let me know that the audio is okay. Let me do a timestamp. Great comments in the comment section. Really appreciate you guys. A lot of a difference of opinions, but so, everyone be nice. Yeah, you guys grow together. It's beautiful to see. Let me know if the audio is okay, guys. Let me mute us real quick.
Claims and housing starts. Oh my God, be still. I'm beating hard. There's the futures down another 600. Tough session yesterday. Rick Santelli standing by at the CME in Chicago. Rick, the numbers, please.
Yes, let's start out with initial jobless claims, shall we? We're expecting a number around 225,000. It comes in on the light side at 215,000, and that ends up being down 9,000 from 224,000, a slight revision. We continue to be so well behaved in initial claims really for years. Just consider we haven't been over 250 since October of last year. Continuing claims, 1,885,000. That is a little higher than expectations. We did see a subtle revision lower in the rearview mirror, but once again, the 1.9 million that we've reached several times have been revised away. The last time we were above 1.9 million, you're going back to November of 21. All right, let's look at housing starts for the month of March. expecting a seasonally adjusted annualized unit pace of 1,420,000. It comes in light, 1,324,000. And that would be the lightest, well, going back to November of last year when it was just a whisker over 1.3 million. That makes it from 1,501,000 last look, down about 11%-ish. On the permit side, a little bit better than expected. So what may lie down the road is a bit better than expected, but I do caution, permits are a little hard to qualify and quantify. So these actually now become preliminary March numbers at 1,482,000, and that would be the best level. It would equal these in November of last year. We were a smidge higher. And finally, the last numbers set that we have before the holiday closure tomorrow will be Philly Fed on the business outlook side, which is the service side, maybe the most important, and it comes in at a dismal 26.4 with a minus sign, minus 26.4. We're expecting a subtle but light positive number, a bit above zero. Minus 26 and change will be the weakest number going all the way back to April of 23. But I caution, many of these regional outlooks, of course, are headline prone, just like University of Michigan, many of these squishy sentiment numbers. So it gets hard to get GPS. When I look at what's going on with the Treasury complex, I guess what jumps out at me is yesterday when stocks were moving down, they really did capture the market and a flight to safety for a bit. And it wasn't a 2-year maturity. It was longer maturities, which means investors, their take on what was going on with equities and Jay Powell was more about the weakening economy. Kelly, back to you.
All righty, that was excuse me, that was interesting. Now I have some bad news. Unfortunately, I was going to move on to the real estate update, and I was going to do a quick MLS search.
Great, you guys feedback.
Huh?
Some sort of feedback.
Okay, is that better?
Yeah.
So more bad news. That was bad news to begin with, but because we messed that up, that was my fault. Bad news, guys. I was going to do a quick update on the multiple listing services. I was going to show you guys, because we've been following Kingwood for so long, especially on these lives, that inventory has absolutely exploded. And not only that, I'm able to now find several properties that are listed for under $100 a square foot. So I wanted to do that right now, but literally I just got an email when that video was playing from HAR that kicked me off of MLS. So I'm no longer on MLS because I just switched brokers. So they waited 72 hours and did it on the live when I needed it, where I can't do anything about it. So I actually left my broker. I was with EXP, and I'm just like, I don't know why I was there, to be honest with you. The fees are absolutely outrageous, and I wasn't even using my license yet, other than the MLS tracking. So I can't do it. But if you guys have a minute, go to HAR.com and look at Kingwood and Humboldt and see how many houses you guys can find that are under $100 a square foot. So it's starting to look really good out there. Not really good, but it's starting to look like I can find deals with both wedge and cash flow. So something may be happening really, really soon here, Mitch. In other words, Raymond just give us a super chat. We're going to go to your presentation now, Mitch. Let me get to Raymond. Raymond, thank you for the support, brother. You don't have to do that. I want to make sure you're always doing well, my friend. I was in the 2008 crash. The GFC largely dictated what happened with the next 15 years of his life. I was 9 years. Messed me up for 9 years. I'm numb about any crash now. It's just numbers and a computer. And I'm going to tell you something about what Raymond just said there. He's 100% right. That's why this whole time, the last 3 years, I've been telling people, yeah, I think the market's going to crash. I've been messed up. You don't want to go through what I went through. But in the meantime, learn the math. Because if you find a deal right now that's, say, 30% in a market, 40% in a market, whatever it is, and it cash flows, that may be what a crash looks like. Only you'll find a lot more houses like that. So in other words, Raymond, the math matters. Use the math. It doesn't matter the condition of the market, as long as you're using the math, understanding how it works, and you're not settling for things that are a POS, quite frankly. So I can find homes with wedge right now in my market, but the cash flow is hard. Raymond, I love you. Hope you're doing well, my friend. Mitch, you ready to do your presentation?
Yes. So I'm going to go.
Tell me when to share your screen. Sorry to interrupt.
Anytime you want.
Okay, I'm going to share it now. The mic is yours.
Okay. So this document is called Truth. U.S. national debt plus unfunded liabilities. And I'm only going to go through the sections that are highlighted in yellow. The document will be below this live, and then it'll get posted. I'm doing that in order to get some speed put into this so we don't bore you to death, but some of this can get a little bit heavy with regard to the mathematical formulas. So for those who are interested, you can download the document. The other advantage of downloading the documents, I actually have links to amortization schedules in here, so that'll be available as well. So Travis, if anything goes wonky as I'm doing this, just stop me because I can't see you at the moment.
I will. You're good
Okay.
though.
Understanding the debt clock, imagine what a stopwatch that instead of counting seconds, counts dollars. And not just a few dollars here and there, but trillions of dollars passing daily. It visually represents how much the US federal government owes to its creditors. The clock doesn't stop, and that's because the debt continuously accrues interest, which is the definition of compound cumulative, as the debt is not being paid off in that it is being rolled up and rolled out. You might be wondering, how did we get here? The answer is multifaceted. The national debt accumulates when the federal government spends more than it takes in from taxes and other revenue sources. The deficit spending has been a common practice, especially during times of war, economic downturns in financial markets, or significant federal initiatives. Over the years, these deficits have added up, leading to astronomical figures that you see on the US national debt clock today. Inflation and debt, what is the connection? Inflation is the rate at which the general level of prices for goods and services rises, causing purchasing power to fall. Think of it as the reason why your grandparents could buy a candy bar for a nickel. You're shelling out more than $1 for that exact same treat today. Now, think of it in today's world where the Federal Reserve has printed trillions of dollars for such nefarious purposes, such as covering the debts of what would be defaulting banks. But how does the national debt play into this? When the government is in debt, one of the ways it can raise money is by issuing treasury bonds. Investors, foreign governments, and even the Federal Reserve Bank or Federal Financing Bank buy these bonds and they buy the treasury bills. When the Federal Reserve buys these government bonds, it is essentially printing more money, increasing the money supply. A larger money supply can lead to inflation, and it outpaces economic growth. Moreover, to service its government debt, the federal government might print even more money, especially if it's unable to raise enough through taxation or government borrowing. Without a corresponding increase in goods and services, this increase in the money supply leads to inflation. What are the real world implications? So what does this mean for you and me? Inflation erodes our purchasing power. That means the money in our pockets doesn't stretch as far as it used to. This could be especially problematic for those living on fixed incomes, like retirees or those whose income cannot exceed their expenditures. It can also impact interest rates, affecting everything from the cost of borrowing money to buying a home to the returns in our savings accounts. The gold standard and inflation. The US abandoned the gold standard in 1971, a system where the dollar was directly linked to gold reserves. Some economists argue that moving away from this standard has made it easier for the government to print money, contributing to inflation. The power of compounding. Interest on the national debt compounds over time, meaning the US owes interest not just on the principal amount borrowed, but on the accumulated interest. This compounding effect is one reason why the debt can grow so rapidly. How is the US national debt calculated? The US national debt is a figure often thrown around in political debates, news headlines, and economic discussions. But have you ever wondered how this debacle of a number is calculated? Let's break down the components and the math behind the US national debt. Two main categories. The national debt is broadly divided into two categories: Debt held by the public refers to the amount of money the U.S. government owes to external creditors. These can be individuals, corporations, state or local governments, and even foreign governments and entities. They buy U.S. Treasury securities, essentially lending money to the government with the promise of being paid back with interest. Intergovernmental holdings. This is the money the U.S. government owes to itself. That sounds kind of crazy, but it is true. Here's how it works. Certain government agencies like Social Security Trust Fund might have surpluses. These surpluses are invested in U.S. Treasury securities, effectively lending the surplus to other parts of the government. Tallying up the debt. The U.S. Department of Treasury's Bureau of Fiscal Services tracks and reports the federal debt. They monitor the government's borrowing and discretionary spending activities daily, adding up the outstanding amounts of all Treasury securities to arrive at the total national debt. Interest matters. The national debt isn't a static figure. Even if the government stops borrowing today, the debt would still grow because of the interest accrued on the existing debt. That's why I'm saying compound cumulative. This interest is a significant component of the annual federal budget and adds to the debt if revenues do not fully cover it. Well, in 2024, we had $1.8 trillion deficit. Revenues do not cover it. Public versus gross debt. Often you'll hear terms like public debt and gross debt. Public debt refers to the debt held by the public mentioned earlier. Gross debt, on the other hand, is the sum of public debt and intragovernmental holdings. When people refer to the U.S. national debt, they typically talk about the gross debt. The debt ceiling. This is a cap, allegedly, because I keep changing it, Congress sets on how much the government can borrow. If the debt approaches the ceiling, Congress must raise the debt limit or face a potential obligational default. The debt ceiling doesn't prevent the government from incurring obligations, but restricts its ability to pay for them. That's complete nonsense because they just simply move the goalpost. Who are the top 4 owners of U.S. debt? The U.S. government incurs debt by issuance of Treasury securities to fund the deficit between the taxes and revenues versus spending on defense, welfare programs, and interest. As of September 6, 2024, the government's total debt is $35.34 trillion. Japan, China, the UK, Luxembourg, and Canada are the top foreign owners of U.S. national debt. Japan owns $1.12 trillion in debt as of June 2024, while China ranks second in total U.S. debt owned by foreign countries. The UK, Luxembourg, and Canada round out the top 5. The Bureau of the Fiscal Services classifies national debt as intergovernmental debt and debt held by the public. It is important to point out that these countries also have compound cumulative debt burdens. That's a big point. Which country is not in debt? Singapore. Once part of Malaysia until 1965, has become one of Asia's major financial centers and one of the most prosperous countries globally. Its success can be attributed to its vast natural resources and the fact that Singaporean government has no net debt. Singapore's transition from a third world country to a prosperous place in less than half a century was largely due to hard work and focus on the long term, despite the country's vast resources. This privileged situation is a testament to Singapore's resilience and determination. You want to know what else it is? It proves the point that a country actually can run without debt on the back of mom and pop. A country can actually run without fraud being committed on the backs of mom and pop. What country owns the most U.S. debt? As of April 2024, Japan, China, the United Kingdom, Luxembourg, and Canada own that most amount of debt. But what you have to realize is that the public debt is sold as treasuries and bonds, bills, and notes to outside investors, while the intergovernmental debt is owed to governmental programs like Social Security, Medicare, and retirement funds. What country is most in debt? The United States. It has the world's largest debt in terms of dollar amount, and it is the largest economy with a debt to GDP ratio of approximately 121.31. National debt is the combined debt of a country's government, which owes one more lenders, such as other governments, corporations, and private individuals. The United States has the highest national debt in terms of raw dollars, and this is an important point, more than twice that of any other country. It's not that we have the largest debt to GDP, it's that we owe more gross dollars as a result of our debt to GDP because of the size of our economy. However, the dollar amount of a country's debt is usually considered in relation to its overall gross domestic product, which represents the country's ability, allegedly, to pay the debt. In conclusion, the United States debt clock is a stark reminder of our country's financial obligations. While it is easy to dismiss it as just numbers on a screen, the implications of rising national debt are especially concerning, because of inflation, and the concern is extraordinarily real. As informed citizens, it's crucial to understand these connections and their potential impact on our daily lives. By staying informed and advocating for sound fiscal policies, we can hope for a future where our economy remains strong and our purchasing power remains intact. Throughout this document, there are live links to the original sources provided as a means to get you, the viewer, the information quickly and to help you understand what the depths of these problems are. The two largest purveyors of financial fraud on the planet are the Federal Reserve and the central appraisal districts, which are owned by the taxing entities, of which the school districts are roughly 83% responsible for the outstanding fraudulent bond debts that were created at a local level. The total outstanding debt breaks down into debt held by the public, currently representing 78.4% of the total, and intergovernmental holdings making 21.6% of the balance. The latter comprises mainly obligations to Social Security benefits, retired military, and other federal employees. The former debt held by the public is all the debt held by any entities, private or public, outside the U.S. government under the form of treasury bills, notes, bonds, TIPS, those are treasury inflated denominated notes, United States savings bonds, and local and state government securities. It requires management care because, as Jerome Powell, the current chairman of the Federal Reserve, said during his Congress hearing on February 27, 2018, and this is an important quote, there could come a time when the public, the global debt buying public, would come to view that we either weren't prepared to honor our debts or that we couldn't service them. Well, Mr. Powell, who is not loved by President Trump, isn't that an interesting statement by Mr. Powell? The question then becomes, Mr. Powell, Federal Reserve Chairman, what did you do about it since the date you gave that speech, February 27, 2018? The global debt buying public would come to the view that we either weren't prepared to honor our debts or that we couldn't service them. You cannot service them today. This would entail dire consequences, even for an economy as strong as the U.S. economy. The following section on amortization helps explain how all debt from mom and pop is handled, except for the method of the Federal Reserve, which is printing or counterfeiting money to pay the cumulative interest without paying off the debt. The central appraisal districts can print money, but rely on extortion of mom and pop, being pay the taxes or we take the house. Whether the Fed or the CAD, mom and pop ends up paying for their crimes. When you download this document, that's a link to the First Amendment to the criminal complaint, which I strongly suggest that everybody read. Now, I'm going to go over this section really fast because when you download the document, for those who are mathematically inclined, these are the formulas that go to the amortization schedule that Travis just showed you. And I'm sure that most of you have seen amortization schedules in the past. So I'm not going to go through all the formulas, but they're really good. Here's the point. I'm giving you links to all these amortization schedules: home mortgage calculator, simple interest loan, Simple amortization chart. Creating an amortization table. What's involved? How is it done? What's the discussion about it? The balloon payment loan calculator. Line of credit. Adjustable rate mortgage. That's the ARM calculator. And here's more of the financial numbers and the algebraic expressions as to what's behind it. So as you go through this, you can read this on your own, but I have a point. My point is, if every one of you has access to an amortization schedule that says your debts can be paid off in a set period of time, and how much money does it take you to earn in order to pay off those debts, then why is it the Federal Reserve cannot use an amortization schedule and tell the truth to Congress? Why is it we are at the ultimate tipping point right now where there simply is no money to pay off these debts? Why is it not a single solution has been offered by the Federal Reserve? And why is it that the Federal Reserve even exists, given this evidence of what we've come up with in the last week, the evidence of the video coming out tomorrow, and these amortization schedules here? This is a panacea of evidence that proves that the Federal Reserve should have its doors chained. One of the comments you see in the idiot press from time to time is, can't we just tax the rich more and fix everything? At the end of 2010, the total worth of all American billionaires was 1.3 trillion. That is not income, but all the income and all the property. Seizing all their income and all their property wouldn't even close the gap for 1 year. The truth is, if you seize it now, it won't close the gap for 1 week. That's the problem. And you can only do it once. The other point I'd like to make is that all assets in the United States, including government-held assets, since the creation of the United States, total roughly 153 trillion. You have more than that in unfunded liabilities plus U.S. national debt. I'm about to show you that in a second. What are the unfunded liabilities? Suppose you have no assets, no house or savings, and you promise to pay somebody $1,000 per month for a year. Your unfunded liability is $12,000. That's 12 months times $1,000. The federal government has made similar promises for Medicare and Social Security, Medicare Part D, the prescription drug plan. While not setting aside any money for these programs, they don't have any money to set aside for them. That's why they're unfunded liabilities. Eventually, the bill will come due and the government will have to pay those promises by law, or, here we go, change the law, move the goalpost. They're really good at it. What about the Social Security Trust Fund? Doesn't it have a lot of money? The Social Security Trust Fund is invested in U.S. Treasury bonds, which means it has already been spent. Think of it this way. If you give me $1,000 in my right hand and I promise to pay you back in 2 years when you retire, I put the $1,000 in my left hand and I put an IOU, the Treasury bond, in my right hand for the $1,000 and pay my rent with the $1,000. Is there really a trust fund for that original $1,000? Of course not. I have to pay you back the money from what I earn. This is an accounting gimmick, and anyone who tries to tell you otherwise has a hidden agenda and/or is lying to you. How does the extreme national debt impact the price on gold and silver? I'll move through this really fast. Go look at a gold and silver chart. That's how. Gold is hitting all-time highs, and it's literally gone parabolic. And more than likely, I hope there's a bit of a pullback, but given what's on the go with this debt that we're proving to everybody, we're stating it and we're giving the documents, we're giving the evidence, more than likely, what are the odds of gold not continuing to run? I am betting on the camp of precious metals, commodities such as oil. Things have to happen. Things will happen, or unfortunately, we're in for a world of hurt. There's a interesting website, and they produced a document, and you can click on this link. This is a live link here. And they created what was called the Financial State of the Union. And as good as this website is, and as much as I appreciate their effort, it's actually not even close. And I want to explain why. So what they did is they said, okay, fine, we're a group of accountants and we're going to run the real math. Well, what the federal government has, according to the federal government, is 5.7 trillion in real assets. But when you go through what the federal government owes, here's the unfunded Medicare, 67 trillion, unfunded Social Security, 51 trillion, publicly held debt, 28.3 trillion, pension and retiree health care benefits, 15 trillion, other liabilities. They've totaled it up and said, okay, we've got 158 trillion negative. Well, here's the problem. As you go through this, you begin to realize that it doesn't include, on the debts up here, roughly $5 trillion at the hands of Freddie Mac and Fannie Mae. It doesn't include roughly 5.1 trillion of fraudulent school district bond debt. And that's what I'm putting right here. So when everybody tells, well, these are the numbers, they're wrong. And by the way, I do like this company. I like what they're doing. I don't have a problem with it. But they never took into account the Freddie Mac debt, and they never took into account the school district fraudulent bond debt. That's important to point out, because isn't it interesting, as Travis has gone through video after video, evidence of their own reports. One day the report says X, 2 weeks later the report says Y. They're constantly adjusting their own reports to suit a narrative. And that is what deludes mom and pop into believing things that aren't true. The math, it must be looked at, and the math must be available. Part of the problem is quite often the math is hidden. This section here discusses the difference between mode, median, and average. And again, I'm not going to bore everybody with it, but the bottom line is, when you see, which the CADs do, so they say, well, this is average on one hand, then they turn around and say, well, this is the median on the other hand. You can't get to the truth, and you are being manipulated if there are outliers inside of their statements. And more than likely, when a CAD says these are your comparisons, they're using outliers that are in fact not your comparisons. That's how they are fraudulently establishing values, which have nothing to do with the actual value of your property. That's what this is pointing out here with regard to the mean. This is another great site, Peter G. Peterson Foundation, talking about the U.S. national debt clock. And they've actually got their own that they've put together. It's really good. So these are live links to those. Part 2 of this document, and I'm going to go through it again very quickly. Housing expenses. Did you sign up to go bankrupt to support your local school district? Did you know that your valuations on your property have nothing to do with inflation? They don't show it in the calculations, and they don't show the loss of your purchasing power. So as you go through what they're saying in here, these are the average expenses, income and expenses, as stated by the Bureau of Labor Statistics. And you can read this on your own. It's an interesting read to give an idea of what they're saying is the median. But I want to cut to the chase on this. I want to show you something. After you go through all these expenses and they say everything is wonderful and there's a 12% savings, so everybody can earn 12% of what it is that they bring into their household per year, just want to show you something. And I'm getting there. See that number, 77,000? That's what they're claiming is the average expenditures. And they're stating across the United States that the average income is 100,000. So you see average across the United States, the point being that has absolutely nothing to do with Godley, Texas, Johnson County, Texas, Denton County, Texas, the city of Denton, because all real estate and all income is local. So you see, this is the flaw of averages. When numbers are being handed to you and you don't have the ability to understand what's going on because you believe, well, it's the government handing us the numbers, this must be true. Well, if your income is 80,000, and according to the statistics, the average house spends 77,000, that leaves you 3,000, except for one problem. Inflation wipes out your 3,000 immediately. In other words, the report from the Bureau of Labor Statistics that I have here, I'm using it as a cudgel. It's designed to hit them in the head, because what they are producing and handing to the public is itself a fraud. It cannot be true. When you break it down to the strata of the individual locality, that tells you the truth. Here's the problem with what's called the flaw of averages. All real estate is local, as is all income. We proved that roughly 37% of the population is in harm's way of bankruptcy and or losing the roof over their head. And that ties to the fact that the majority of households are over-indebted in credit cards, do not earn the, quote, average across the United States. The average contains skew to the upside for purposes of a narrative. And the average family of four is upside down by roughly $19,000. And we've also given that proof on a video. There has been no savings or retirement as the equity in the home has been stripped, and there is no excess cash flow after expenses. What was once a home as an asset has been turned into a liability. The U.S. national debt plus unfunded liabilities cannot be paid off through income taxes. The local school district fraudulent bond debt cannot be paid off through real estate taxes. The combination of financial crimes against humanity requiring the cessation of compound interest, walk down of off-balance sheet derivatives, workout of bonds marked to market for true value, elimination of all fraudulent school district bond debt, and the repeal of real estate tax in favor of the uniform state sales tax, which restores the balance sheet to mom and pop, from which they will have something to retire with. The whole purpose of this is to end up with that one statement. Those who have the privilege to know have the duty to help, and we're hopeful that the Discord will prove beneficial for people being able to help people. Travis?
Very good. All right, you are back. You're getting really good, really getting good at those reports. Had a couple people ask, at least one person asked where they can get this document. I will have a brand new link going to Gmail as soon as about like 20 minutes after this live. So I'll go back in, I'll put the chapters, and then I'll upload that document to a Google Drive. It will have a link. So come back to the video about 20 minutes after it ends, and you'll be able to access that document. And please share the document. Mitch spent a long time on that document, at least 4 days. I can remember going back and forth with him. So that is in the description. We have a super chat. I'm going to move on to the Q&A portion of this video. Let me do a quick timestamp. And Mitch, I want to get through these comments super quick. We got some real good ones. But first, the super chat. Let me put the super chat back up here. Oh, this was from Charlie. So no question from Charlie, just showing his support. Thank you, Charlie. Charlie, join the Discord. It's only $10. You could use that $10 and went to the Discord. My brother, please go to the Discord. It's only $10. Be one of the first people to join that. It's in the link in the description. Thank you for the support. Really appreciate it. Mitch, I'm going to rapid fire some stuff at you. And here, let's both of us actually. And let's see. First thing here is, okay, quick, Mitch. I'm going to give this one to you. This is from Sheldon. Sheldon, thank you for your comments and questions. Will the Fed bail out the bond market? Mitch and I go back and forth with this all the time. This is probably the thing we talk about the most, Mitch and I.
The Federal Reserve, the doors need to be chained. I fear the answer to your question is yes. I know the ramifications of doing so, which means printing more money, which means the Weimar Republic. You just simply can't get there. We've looked at the math. Like I said, this is going to take some very serious people. And there's an opportunity here globally because we're not the only ones in this position. China is in a world of hurt, as is the UK, as is the Euro, France, Germany, Italy. They're all in bad positions. There is an opportunity here to sit down jointly and say, we are going to wipe out, it's called a workout, debts that are paper chasing paper. And that will go a long ways towards fixing this problem. Nothing in life is perfect, but we've gone so far to the extreme that the ultimate result will be a necessary cleansing, which means the system will collapse. And if they go to print, the system will collapse and it'll do it globally.
Mitch, here's another really good comment right here. And you and I talked about this when we were doing some of the live videos last week about how China may be crashing their currency on purpose so that they can pay off their debt. This is a comment from Educated Monk saying they're helping China out as gold rises, all by design. do you still agree with what we were talking about last week, that China could be doing this on purpose so they can devalue their currency so that their debt is cheaper to service and pay off?
No, they're doing it on purpose with regard to the narrative. You have to bifurcate the issue. So they're saying, oh, yes, well, this is what we want, et cetera, but it's the reality of the economy, because when you have other countries that are saying we're going to pull back and not buy those goods, then the inverse of that, in order to get people to buy those goods, they want to keep their currency low. They are manipulating their currency. They've been doing it for years. It's nothing new, but you've got to bifurcate the narrative and then you get to the truth. But their economy, they have built ghost cities that have cost them trillions to build. There's nobody there. It was an illusion. They're no better, even though it's a central policy, et cetera. They're no better than what our Federal Reserve has done. When you lie and you print money and you take the economic engine of mom and pop away by virtue of the inflation, you are going to crash whatever that system is at that point in time. It's not a question of if, it's just a question of when.
Okay, I got another comment right here from High Vibes. Who now I want to specifically putting this comment up for a second. They're asking, who is the best company in Texas for appraisal value to be lessened? Now, I could have got with a company, created an affiliate. I could have done all of that. I didn't do it because I want to push and emphasize on self-education, because I need you, High Vibes, to help your community. I understand also, though, that there are people that just, they don't have the time. And if you don't have the time, High Vibes, I talked to Michael Bordonero yesterday. And Michael Bordonero, you guys probably know him. He has a YouTube channel. He has an affiliate link with some companies for appraisal value fighting. So if you want some of that information, go to his. I'm more about you learning. I want you, High Vibes, to just give me an hour, hour and a half of your time and learn this process. It's really easy. But I know some people hate math and some people don't have the time. They want to spend some money to have someone else do it, and that's fine, but that's not what I'm about. I love you. Thank you for your comment, my friend. Couple things here. Hi, guys. Unfortunately, the middle class needs this to get even worse. It's going to hurt, but we need it. And this is why for the last 3 years, I've been trying to teach you guys to be cautious, yet at the same time teaching you the math, saying, if you got to buy, you got to buy. Here's how you do it. I don't agree with it, but here's how you do it. People are going to get hurt. That's why I've been hedging for so long. And even then I got hurt. Now I got hurt, not necessarily for economic reasons. You know, I lost a lot of my savings and purchasing power through the hurricane, and I'm just now starting to get that back. But the reason we've been talking about this is so that you guys save your money, rebudget, and you can position yourself to get hurt less and hopefully become a winner on the other side of this thing, because a lot of millionaires are made during recessions. Don't forget that, guys, because it's so few people have the discipline. So few people have the discipline and desire to do something about it. So just take a step back from your spending, like I did as well, and readjust your lifestyle. My wife and I rebudgeted last weekend during tax season. Now, another comment here. Trump called Powell a big loser today. Yeah, that's why the market's down, right? It has nothing to do with the derivatives. I thought that was a funny comment, though, because that's what's been in the headlines this whole time. It's been Trump yelled at Jerome Powell, so the market's crashing, when they're not talking about derivatives. They're not talking about debt to GDP. They're not talking about real median household income. They're not talking about the important things that we've been discussing for a very long time. Another comment. Now, I want to give a big shout out to, what is it? Dissident. This guy has been making some really sharp comments. I've been enjoying his comments. I don't get how tariffs cause inflation if it removes liquidity from the system. I suppose it will if they print money to compensate and do QE. Do you want to respond to that, Mitch?
He's got it right. I mean, that's the net result. So the tariffs are not new. They've been used for 100 years. I mean, every country has done it, rightfully or wrongly. Should there be a free trade globally? Ideally, yes. But then you get one country gets greedy, or they have an economic problem, so they hold their hand up for money and they slap a tariff or a customs duty on something. So it's nothing new. It's being used by President Trump as a negotiating tool. This is never stated in the press. They don't know. They don't understand. They couldn't negotiate their way out of a paper bag. If you lit it on fire, they couldn't do it. So that's the problem that President Trump, in reality, he's not saying it, but that's the problem that he's got with Jerome Powell. Powell may be a very nice guy, but he literally could not negotiate a lollipop away from a child. And if he could, that statement that I read to you that he made in 2018 is clear proof. Well, you knew there was a problem. What did you do about it? Did you go to Congress and start jumping up and down and saying, hey, we've got a problem here. We can't pay these debts. You didn't do it. And President Trump has every right to be pissed. He's wrong. He's pissed at the wrong guy, right? What he should be doing is looking at the Federal Reserve and saying, that's it. We're moving to Congress to shut this thing down. But he needs a team of people that understand how to negotiate the debts and what needs to be done. And I just don't know, as we sit here today, what they know. I'm a little bit concerned. You know, the bottom line is we've got criminal complaints out there. We haven't heard back on that either. So I don't know what these people know. But we'll keep hammering away because we've got the evidence.
They got us working twice as hard. I feel like they got us, their lack of response has us working twice as hard. I mean, I can't even take a day off anymore. I was supposed to take the evening off, but we because the video, we worked all morning today, but I mean, but I need to hedge myself, right? I need to maintain my purchasing power. So I'm working like double. Another good comment from him. I mean, he's on fire today. And this is what he's saying. It's silver that is going to have a structural supply deficit as industry demand continues to accelerate. It will be a safe inflation hedge going forward. I hope so, because I started buying silver. You guys know that. Remember during that downdraft that Mitch warned us about, I bought some silver. And then during that process, I also educated my 9-year-old. And I said that I will teach you how to make money when you understand what money is. And obviously it was Easter. Judas sold out Jesus for 30 silver coins. So you see how this all ties. And also my mom converted. My mom's Jewish. So I saw those comments and that hurt my feelings, what you guys were saying. Good people. I'm still Christian. I don't want to go into religion, but I could speak Hebrew. And actually, I won't go there. Love those people. Anyways, Sean, the good people. Sean and Wendy, God is amazing. Thank you, Sean and Wendy. Travis, you made us, this is a compliment as well to you, Mitch. Travis, you made us smart, but Mitch makes us smarter. I love that about you, Mitch. You're a smart guy. So I love one of the reasons why I love you so much. And together you make us both superb, award-winning. Thank you, Sean and Wendy. They've been here from the beginning. I really appreciate you guys. I mean, look at this guy. He's on fire, Mitch. Unfunded liabilities combined with low birth rates are the main reason they push consumption and need inflation. What do you think about that?
Yeah, he's right. And he's also right on silver, except that silver, when the world wakes up, so when something bad happens, we get another huge down spike, then mom and pop will wake up and say, okay, we've got a problem here. And they will say, precious metals may be the next source for us to put some money in, buried in the backyard, whatever. But the point of the matter is when mom and pop wake up, you will see silver jump and it'll make gold on a percentage basis look like a piker. So right now, gold is in the lead, but there will come a day when all of a sudden you will see the futures of silver spike and it'll be $3 a day and it'll start taking off.
I'm hoping so. I'm investing in it. Great comments from him. Okay, got a couple more. This is from Charles. I can't remember why I put this one. Location. The cost of materials go up, labor goes up, so the floor of home prices set. Charles, I'm surprised to hear you say that because you made the massive mistake of leaving out really important things because a lot of people say this. And can you guess what those things are, Charles? I want to see you in the comment. What are the 2 things we keep saying everyone you're listening to, except for us, are leaving out? What are those 2 things? Number 1, household income. It could be median, nominal. It could be real adjusted for inflation, real or nominal median household income. Number 2, what about the massive debt bubble we're in? I mean, if the debt bubble doesn't matter, then just keep printing, right? If median income doesn't matter, then why do we have debt to income ratio? Those things matter for a reason. It's just we keep forgetting that when we're in the speculative thing. Charles, that doesn't mean I don't love you and I don't appreciate you and your comments. I really do.
There's a flaw with that statement. So the flaw is it's a trap. Well, it's a trap that the appraisers themselves, right? Central appraisal districts use that trap as a narrative against mom and pop. The point is that a new house should never, and there is no math on this planet and no appraisal law to justify it, a new house should never be compared to an older house, ever. That's the trap. So when they use a comparison against you of a new house as compared to an old house, it simply isn't true. It's a fraud.
I love this comment down here. It's not investing in silver. It's protecting your purchasing power. That's exactly what I'm trying to teach my daughter, because she's like, Daddy, when is it going to go up? I'm like, no, it's not about it going up. It's about you understanding that this is real currency. This has value here. That little piece dollar that you have, right? It don't have no value. So it's about keeping it and holding it and protecting your legacy, protecting your purchasing power. I agree. And then in that sense, you don't have to worry about when to sell and things like that, but you have to have the discipline and you have to buy for the right reasons. I'm not giving investment advice. And then where was Monica's? It's right here. Monica says, I love that she said this. Our only crime was not calling out the corruption over all these years. I know I'm guilty of that. I mean, I was just naive and foolish with my head in the sand. Not my head in the sand. I just didn't realize the extent of the derivatives market, for one thing. Austin, thank you, buddy. We got a super chat here. This is from Austin. Thank you for the $10, brother. I've said this to you before, Mitch. This message is too important to only share it via this channel. Reach out to even medium-sized YouTube channels. Reach out to other channels so that it can go and provide the population and with more knowledge and create awareness. I wonder who's been telling you that, Mitch? Who's been trying to get you to go on other channels, huh? Who's been doing that? I've been saying to Mitch all the time, it's time for you to start going around YouTube and start getting on other people's channels, because it's big. This movement is bigger than you, me, and Real Estate Mindset. Have I not been saying that to you, sir?
Yes, you have. It's a bit of an issue because when we're engaged in a conversation, things come out, because I've got all sorts of stuff rattling around in here. And the problem is, if somebody doesn't know what questions to ask and what buttons to push, I don't talk. It's I've spent my entire career sitting and thinking. So it was like that until Travis said one day, would you like to do a podcast? And I said, sure. I didn't. And then I asked him, what the hell's a podcast? I didn't know. So I need somebody who understands what the real estate is about and understands where I come from. There's been a couple larger channels that said, okay, come on here. But the other problem is that, they'll give you a short window, 5 minutes, as you can clearly tell, isn't going to work. So it's a matter of finding the right people who are smart at what they do and can ask the right questions. And that's a pretty unusual, as I'm discovering, a pretty unusual situation.
But I have given you some names of some people that I think, like Adam Tagger, like where's Adam at? That have, anyways, I agree with Austin. This movement is huge. We need more awareness, whether it's on this channel or another channel.
Right.
We all win together. It's not about just being on Real Estate Mindset. I want this man all over the place, on the news, everything. The more people that listen to you, Mitch, and you articulate what's going on, the better. It makes us all stronger. Thank you for the support, Austin. I really appreciated that. That was very nice of you. Let me take this off here. So real quick, just one more time, you guys, we're going to end this out here. And again, if you want the conversation to continue, don't forget, okay, it doesn't have to end here. Let me remove this. Sorry about that, Mitch. Doesn't have to end here. Join the Discord. It's $10 a month. The link is in the description of this video. You get to talk to Mitch and I. We've been struggling with our emails. You get to talk to other great people, but be one of the first people to sign up to the Discord. We will keep it going after this. And don't forget, especially if you're in Texas or if you're a realtor, sign up for How to Protest Property Tax Home Value. That is this Saturday. The link will be in this description. Mitch, I'm going to get him out of here. Any final words you'd like to say?
With a little bit of luck, the goal of that Discord is people helping people. We want to be able to educate people. We're going to have links to the different, my site, et cetera, as circumstances arise. But that's really the goal. So if we can get a base or a nucleus of people who are well-trained and well-versed in this, then that would be wonderful, because the amount of emails that we're receiving, like we're getting an email every 15 or 20 minutes. And if it's an emergency, I'll deal with it. But there's just simply not enough hours in the day. So if we can get this nucleus of people answering these questions, again, people helping people, then this would be a one of a kind. I've not seen this done anywhere, but there's certainly justification. I received another package a few hours ago on a tax lien foreclosure. He actually sent me a copy of his lien. Of his lawsuit. So these things are happening at grease lightning speed. We want to be involved. Now, he went and filed it. I can tell you he needed some help because I didn't like the way it was formatted and some of the stuff shouldn't have been there. But nonetheless, he handled it and he's dealing with it.
Yes.
Had he had somebody else to rely on that was live on this type of Discord,
Yeah.
that may have made a huge difference for that person.
And also, as much as we try and want to help people and want to give back, you know, Mitch can't help every single person with the lawsuit. So if he's able to answer some of those, and same with me, some of those complex questions on the Discord, you guys get that information there. So he's been doing a good job. I wanted to show you guys real quick. So I've made separate channels, and each of these channels has a description, it has links, and it has basically the purpose of the channel and what to do next. And real quick, I wanted to give a shout out because about 4 people signed up. There's Mitch. So you guys see that Mitch is in there. Big shout out to Cap Adventure, New Guy 69. There's Nikki. Nikki, it's nice to see you. And it looks like 1857.93. So we got 4 people that signed up. Again, you guys, first people to sign up there. Join the discussion after this. We really appreciate you. And Mitch, I'm going to get him out of here. So again, you guys, don't forget, about 20 minutes, I'll have the link to the presentation Mitch gave, and I will have this thing chaptered. We'll see you guys next time. Don't forget, tomorrow, 59-minute video. It's a juggernaut. Please, you guys, watch that video. We put our heart and souls into that video, especially Mitch here. It is such a great video. And other than that, you guys, if you guys are out there investing in yourselves, in your lives, you guys already know, we wish you luck, and we hope you win.